Hi, I'm Kevin Walton with C2 Reverse, and I do reverse mortgages. I have people consistently ask me, why are reverse mortgages so expensive with upfront costs? What they aren't aware of is that there are now new low-fee reverse mortgages available. But it's important to note that not all reverse mortgages are the same, and they have different rules and fee structures. In this video, I'm going to break down the loan fees, show you some numbers on the more upfront expensive reverse mortgage loan, and compare it to the low-fee reverse mortgage loan, and lastly do a 5-year snapshot comparing the loans to each other. Many people do not know that the HECM reverse mortgage is in the family of FHA loans. Why is that important? All FHA loans are required to keep MIP, which is mortgage insurance premium. This protection has to be on their loans. It protects the lender for the life of the loan, but it does not protect the borrower. This means for the federally insured FHA HECM reverse mortgage, you are required to roll into your loan amount an upfront chunk of money to start this insurance policy, and then an additional monthly premium is calculated and added to your balance as well, assuming you don't make any monthly mortgage payments. Because again, on a reverse mortgage, you don't have to make a mortgage payment if you don't want to. This upfront MIP insurance represents 80 to 90% of your upfront HECM reverse mortgage closing costs. So what does this insurance do? In the event when it comes time to sell your home and you owe more than what it's worth, it pays that gap. When borrowers have a reverse mortgage and use all the available funds and do not make a monthly mortgage payment for possibly 20 years or more, it's entirely possible that in certain parts of the country there will be properties with reverse mortgages that are underwater when it comes time to sell the property. This insurance is vital to the sustainability for the FHA HECM program, but it does come at a cost to the consumer. But people believe this insurance, this upfront cost, is only on reverse mortgages, and that's a penalty of some kind for people over the age of 60. But it's not. It's actually for all FHA loans. FHA does all different kinds of loans: first-time homebuyer loans, buy and rehab home loans, energy efficient mortgages, and others. Each one of these FHA loans have different upfront and monthly premium structures, but they all require MIP for the life of their loans. Many people over the age of 60 have never used FHA for home financing and have not heard of MIP. On conventional loans, which are different from FHA loans, PMI insurance, which does the same thing as MIP, is required when your first mortgage is financing greater than 80% of the home value. But PMI does not have near the upfront costs that an FHA loan has. Okay, we've talked about MIP for the FHA HECM reverse mortgage and how it represents 80 to 90% of the upfront cost to get the loan, but how much does it cost? The upfront MIP premium that gets rolled into your loan amount as of July of 2021 is 2% of the property value, with a value cap of $822,375. Reverse mortgages can be done on higher property values than that, but the MIP premium calculation for the upfront cost does not go above a value of $822,375. By the way, this cap is a Southern California high cost cap. Other California counties and other states and their counties have different loan limits. You can view the various state and county loan limits by going to FHA's website. Just keep in mind each year these figures are subject to change and usually go up. So here's an example. We have John and Mary applying for a $200,000 HECM reverse mortgage line of credit, and their home was worth $700,000. The upfront MIP is $700,000 times 2%, which in this case is $14,000. This amount gets rolled into their HECM proposed loan amount. The monthly MIP premium is the balance times 0.5% divided by 12 months, which in this case is $83.33. If the borrower chooses not to make monthly payments, the mortgage balance rises, and also the MIP monthly premium gradually rises as well as the balance goes up. The MIP is for all FHA loans, again, not just for the HECM reverse mortgage, but not all reverse mortgages are FHA HECMs. Here's an actual sample of a HECM final closing cost sheet with for a $375,000 loan on a property valued at over $1 million. Look at the bottom right line, the right-hand column at the very bottom, $18,145.95. In closing costs, that gets added to this loan amount. Again, it's not out of pocket. It does get added to the loan. Go halfway up that far right-hand column, you'll see the upfront MIP premium cost of $15,312. This calculation was when the value cap was $765,600. This represents 80% of all these closing costs. You will notice all the other costs are similar to a normal real estate loan. You've got title insurance, escrow, notary fees, appraisal, recording charges, all those fees you incur on any loan, whether it's a forward loan or a reverse mortgage loan. What is different on the FHA is the upfront MIP premium. Now let's take a look at an example of an FHA HECM line of credit loan which has the higher closing costs, but it has a lower interest rate. And we're going to compare that to a non-HECM low upfront cost line of credit loan which has a higher rate, and how each loan looks after 5 years. I think these numbers are going to surprise you. So we have a 71-year-old couple applying for a $400,000 HECM line of credit reverse mortgage. Home value of $700,000. We're going to pay off their existing first mortgage balance of $182,500 because we have to pay off the first mortgage to even get a reverse mortgage to begin with. And then we're going to finance $17,500 in closing costs. We're going to roll that into the loan amount. $14,000 of that is upfront MIP. The loan start rate is 2.455%. This is in a monthly adjustable line of credit. The rate can go up 2% per year with a maximum of 5% over its lifetime. So it can never go higher than 7.455%. There are other reverse mortgage line of credits with different adjustments. But this one is a monthly. Let's go down to the bottom right here. You'll see what the balance on this loan is after 5 years. See where my arrow is? It's just right below that arrow in the bottom right. $227,223. That's what this balance has worked its way up to after 5 years. At the end of year 2, you'll see right here where my arrow was circling, I bumped the interest rate by 0.5%. The rate's not going to stay at 2.455 forever. We're in a rising rate environment, and I thought a 0.5% in the second year bump in rate might be appropriate. So again, after 5 years, $227,223 is that balance after 5 years. Now let's compare this to the non-HECM line of credit. Same example, but in this case, we have no upfront MIP to roll into the loan. So instead of a starting balance of $200,000, we're at a starting balance of $186,000, which also is going to include $3,500 in other costs for the loan, which is $14,000 lower than the HECM. But this one has a higher start rate of 5.5. Now look at this loan, bottom right again. $244,000 is the balance on this loan after 5 years. That's $17,000 higher than the HECM. and you start out with a loan amount of $14,000 lower. How could that be? Well, it's the 3% higher in rate. Look, though, at year number 2 on this non-HECM. The balance is $206,000. That's lower than what it is on the HECM. The HECM at the end of year 2 was $211,000. So this non-HECM loan, it might be a better deal over the short run. So I answered the question why FHA HECM reverse mortgages are expensive with upfront costs, and that's due to the upfront MIP. We also covered the low upfront cost non-HECM reverse mortgage loan and compared it to the federally insured FHA HECM after 5 years and how which one may benefit you in certain circumstances. As far as reverse mortgage fees go, keep in mind typically there's always a cost to access liquidity. Whether you're tapping into an investment, there could be upfront taxes you incur, or ongoing capital gains in state and federal taxes, or sales commission if you're selling a home, or, like in this example, costs for a loan. A reverse mortgage has become a Swiss Army knife of sorts for people over the age of 60. You can use it to buy a home, cash flow during retirement, pay for aging in place medical expenses, a senior divorce tool, and a bucket of money to dip into when the stock market takes a nosedive. Subscribe to my YouTube channel. I'll be making videos on each one of these topics. So in conclusion, just know there are several different types of reverse mortgages that are uniquely different from each other and have higher upfront closing costs. Some may have that and others may not. It all depends on your situation. Sometimes it's better to have the higher upfront cost loan because there's less interest expense in the long run. It just depends on your situation. So if you live in California and need scenarios like this one I showed you, comparing two loans over 5, 10, 15, or 20 years, let me know. I'll run your scenario for you and I'd be happy to do it for you. So thanks for watching and stay well. Bye now.